You might think a gold loan is about as simple as it gets. Walk in with gold, they check it out, give you cash, easy.
Right. Transaction done.
But if you really peel back the layers on this sector in India, especially how the big non-banking financial companies, the NBFCs, operate,
Yeah.
well, it gets way more complex.
Absolutely. You've got global gold prices doing their thing, bouncing around.
And then detailed financial regulations changing underneath. It's dynamic.
That's exactly the space we're diving into today. It's this fascinating intersection, isn't it? Traditional practice meets the modern financial world.
Yeah, pledging gold for cash, it's ancient. But it's huge for millions, provides that quick liquidity against, a real asset.
Mm-hmm. And our guide for this deep dive is a pretty fresh report from ICICI Securities. It's dated June 10th, 2025.
Okay, so very current.
Yeah, and it zooms right in on the Indian gold loan NBFC sector, looks closely at the market and especially to the big names, Muthoot Finance and Manappuram Finance.
Got it. So our mission here is to really unpack what this report is telling us.
Exactly. We want to understand, what's the state of play right now? What's driving things? How are Muthoot and Manappuram actually doing according to this analysis?
And there's something about new regulations. That sounds important.
Oh, definitely. A major new regulatory framework just dropped. We need to unpack that too.
Okay, let's get into it. The report starts off sounding pretty positive. It talks about a current positive cycle for these gold loan companies. What's making things look so upbeat?
Well, the report points to a few key things, creating some nice tailwinds. For one, interest yields have been relatively stable. That's always good for lenders.
Stable income, yeah.
But the big one, and probably no surprise here, is gold prices. They've really surged.
Ah, right. The price of gold itself. How much of a boost are we talking?
A huge one. The report mentions an average monthly increase of around 25% in gold prices just year to date in 2025.
Wow, 25%.
Yeah.
In less than 6 months. That's massive.
Oh,
Does that directly mean more business?
it absolutely does. Think about it. When the value of the collateral, the gold goes up like that.
Lenders can offer bigger loans for the same amount of gold, right? Within the limits, of course.
Precisely. So it boosts their assets under management, their AUM, just naturally. And, it makes gold loans more appealing because borrowers can suddenly access more cash with the same jewelry.
So it's not just maybe more people taking loans, but the size of the loans they can get against the gold they already have is going up too.
You got it. And the report also hints there might be an extra little push from restrictions maybe tightening up elsewhere, like in unsecured personal loans.
Okay, so if it gets harder or pricier to get a regular personal loan.
People needing quick cash might just turn back to gold loans more often because they've got the asset right there.
Makes sense. Kind of a double whammy, gold's more valuable and other options might be narrowing.
And this isn't just guesswork. The report backs it up with data. They're seeing increases in both the total weight of gold pledged, they call that tonnage,
Right.
and in the number of customer accounts. Both clear signs the sector's growing.
Okay, so the overall market tide is rising. Now let's zoom in on the two big fish the report focuses on, Muthoot Finance and Manappuram Finance. How are they doing in this environment?
Right. The report puts them side by side. If you look at projected AUM growth assets under management for their core gold loan business,
Yeah.
the analysts forecast Muthoot's standalone gold AUM to grow at a compound annual growth rate, CAGR, about 16.2% between financial years 25 and 27.
16.2%. Okay. And Manappuram.
Their gold AUM is projected a bit lower, around 14% CAGR for the same period.
So based on projections, Muthoot's expected to grow its main business slightly faster. But wait, they both have microfinance arms too, don't they? How does that fit in?
They do, and this is where the stories kind of diverge a bit more, according to the report. Muthoot's MFI bit, Belstar, that's factored in with pretty healthy 7.5% AUM growth.
Okay, positive contribution there.
But Manappuram's MFI arm, Asiabad, that's actually factored in with a decline, a 3.6% decline in AUM.
Oh, right. So Manappuram has this MFI drag on its overall growth picture, while Muthoot's MFI is adding to growth.
Yeah.
That's a key difference.
It definitely shapes the overall outlook. The report also gets specific on actual gold tonnage growth, the physical weight of gold coming in.
How did they fare there?
Muthoot apparently saw really strong growth here in FY25. Tonnage was up 11% year on year. That's a big jump from just 4% the year before.
11% increase in physical gold pledged. So they're pulling in significantly more metal. What about Manappuram?
Well, Manappuram's tonnage actually went down, declined by 4% in FY25, and that followed a 2% decline in FY24.
So a clear difference in trend there. Muthoot's gaining gold collateral, Manappurum's losing it, recently at least.
Yeah, the report shows historical data. It fluctuates for both, but the recent trend is quite distinct.
What about bringing in new customers?
Muthoot seems stronger there, too, in FY25. New customer additions were up 12% year on year. That compares to 7% growth in FY24.
And Manappuram.
Their customer growth was slower, 3% in FY25, down from 5% the year before. And Muthoot's total loan accounts grew by 17% in FY25.
Okay, so across tonnage, customer growth, loan accounts, it looks like Muthoot had a stronger FY25 based on these metrics. How does the report translate this into, like, stock recommendations?
Well, based on all that, they're maintaining an ADD rating on Muthoot Finance, and they've actually bumped up the target price to INR 2,670.
And a reason.
Basically factoring in that higher expected gold loan growth and giving it a higher valuation multiple because of it.
Makes sense. What about Manappuram then?
For Manappuram, it's a downgrade. From buy down to hold, the target price stays the same at INR 260, though.
Why the downgrade to hold?
The report suggests the implied value the market's putting on Manappuram's gold business seems a bit high, especially when you factor in that MFI decline we talked about.
Right.
Plus, they note the stock's already jumped, 39% just this year in 2025, so they feel the current price probably already reflects a lot of the potential growth.
So the market's maybe gotten ahead of itself a bit on Manappuram, while the analysts see more room for Muthoot based on current trends.
That seems to be the gist. They also mention any potential boost for Manappuram from, say, private equity coming in might take a while to actually show up in the numbers.
Got it. There was also an interesting point in the report about the link between gold prices and AUM.
Yeah, this is fascinating. Historically, you'd expect a super tight link.
Totally. Gold price goes up, value of collateral goes up, AUM goes up, almost one-to-one.
And it basically was. The report says the correlation was like 0.99 for Muthoot and 0.96 for Manappuram. Almost perfect.
Wow.
But they're saying that correlation has actually slipped just a little bit recently.
Oh, why would that happen?
Well, they suggest a couple of reasons. One is just increased competition. More players, maybe more aggressive lending terms, could decouple growth slightly from just the gold price itself.
Okay, competitive dynamics playing a bigger role.
And the other thing is the company's own efforts to diversify, like building up those MFI businesses. As they grow other segments, their total AUM becomes less purely dependent on gold price swings.
That's a really important point. Even with gold prices being this huge driver right now, other forces, competition, diversification, are starting to subtly shift that direct relationship.
Yeah, it suggests the sector is, maturing, becoming a bit more complex than just riding the gold wave.
Absolutely. Okay, let's pivot now to something that sounds like a really major development. These new RBI regulations. The report spends a lot of time on this.
It really is a big deal. The RBI issued these new directions for gold loans on June 6th, 2025. Very recent.
And the goal is what? Just update things?
It's more than that. The report says the aims are broad. Create a more harmonized framework so rules are similar for different kinds of lenders doing gold loans.
Okay, level the playing field a bit.
Yeah, clarify things that were maybe ambiguous before, address some past concerns, and fundamentally really strengthen how these companies operate and how borrowers are protected.
So, consolidating rules but also raising the standards. The report breaks down a lot of specifics. What are some of the key changes we should know about?
One big area is more scrutiny, especially on larger loans. For total loans over 0.25 million rupees, 2.5 lakhs to one borrower,
Yeah.
they now need a detailed credit assessment. That includes checking the borrower's actual capacity to repay the loan.
So it's not just about the gold value anymore for bigger loans. They have to look at the borrower's finances too. What about renewing loans or getting top-ups?
Renewals and top-ups are still allowed if the borrower asks, but now they also need that credit assessment check. And they have to stay within the LTV loan-to-value limit.
Okay.
Plus, the existing loan needs to be standard, meaning not overdue or in trouble. And there's a specific rule for bullet repayment loans, the ones where you pay it all back at the end.
Right.
For those, any interest that's built up must be paid off completely before the loan can be renewed.
Got it. So you can't just keep rolling over the interest forever. Any new rules about what the lenders can do with the gold itself once they have it?
Yes, two really important ones. First, lenders are now explicitly banned from repledging the gold they've taken as collateral.
Meaning they can't use customer A's gold as collateral for their own borrowing.
Exactly. Reduces systemic risk. Second, they also can't lend against gold that's been pledged to another entity by its borrowers. Kind of stops a potential chain reaction.
That seems like a crucial safeguard. preventing the same gold from backing multiple loans down the line.
It is. And there are also new limits on how much metal one person can pledge. Aggregate weight limits per borrower.
What are they?
It's 1 kilogram for gold ornaments, 10 kilos for silver ornaments, 50 grams for gold coins, and 500 grams for silver coins, per lender across all their loans.
So you can't just pile up unlimited metal with one NBFC anymore. How about valuing the gold? Any changes there?
Yes, very specific. Only the intrinsic value of the gold or silver metal itself counts. Things like precious stones, diamonds, whatever else is on the jewelry. Excluded. The loan value is based purely on the metal content.
Okay, just the metal. And this links to those new tiered LTV ratios the report mentioned.
Yes, this is another big one. New maximum loan-to-value limits, and they're tiered based on the total consumption loan amount per borrower.
How does that work?
It's 85% LTV for loans up to 0.25 million rupees. Then 80% LTV for loans between 0.25 and 0.5 million, and 75% LTV for loans above 500,000 rupees.
Okay, a sliding scale based on loan size. Less leverage for bigger loans. But the report highlighted something really significant about these LTVs.
Yes. This LTV limit, it has to be maintained throughout the entire loan tenor.
Maintained throughout. Wow,
Yeah.
that's different. So if gold prices drop sharply after you take the loan,
Yeah, it implies, well, the report doesn't spell out the exact mechanics like margin calls.
but potentially the borrower might need to add more gold or pay back some principal to stay within that LTV limit.
That's the implication of maintaining it throughout. It's definitely stricter than just checking LTV at the start. The regs also demand more standardized and transparent processes for assaying, testing the purity, and valuing the gold.
What does that involve?
Lenders need uniform methods for testing and weighing, same across all branches. They have to put their valuation methodology up online. And critically, the borrower must be present during the assaying.
Ah, so you see it happening.
Right. And any deductions, like for stones, have to be explained and documented right then and there.
Adds transparency. What happens if the gold gets damaged or, worse, lost while the lender has it?
The rules are clear. Any loss, damage, discrepancy in weight or purity found later, it has to be recorded and the borrower must be told immediately. They also have to provide details on the compensation process.
So the lender's definitely on the hook if something goes wrong in their vault. The report also mentioned documentation and communication changes.
Yeah, loan agreements need to be standardized, much more comprehensive. They have to clearly list everything. Description of the collateral, its value, the auction procedure, including the notice period,
Right.
timelines for getting the gold back, how any auction surplus gets refunded, and all charges. Those charges also have to be in a separate, clear, key facts statement.
A KFS. Standard across loans now. Good.
And communication, including the agreement, has to be in the borrower's regional language, or one they choose. And for illiterate borrowers, the terms have to be explained verbally with a witness present.
And the witness can't be a lender employee. Right.
Correct. An independent witness. It's a solid protection measure.
Definitely. What about just the physical handling and storage of all this gold?
Needs proper infrastructure.
Yeah.
Secure safe vaults, has to be in manned branches. Only the lender's own employees can handle or store the collateral.
No outsourcing the vault, basically.
Right. Systems need regular reviews, staff need training, internal audits are required, and this includes periodic surprise verifications of the gold stock in the vaults.
Surprise checks. Interesting.
Yeah, the report notes the loan agreement should probably get borrower consent for these checks up front. Adds another layer of oversight.
Makes sense. Okay, loans paid off. How quick do you get your jewelry back?
Maximum of 7 working days after full repayment, though the report adds, ideally, it should be the same day.
7 days max. And you get to check it when they give it back.
Yes, verification at release to the borrower's satisfaction is required.
Good. Now, auctions. This is obviously a sensitive area. The report said the rules here are very detailed.
Extremely detailed. Transparency seems to be the main goal. Lenders have to give the borrower adequate notice before starting any auction process.
How much notice?
The rules don't specify exact days in the summary, but it has to be adequate. If they need to issue a public notice about the auction, there has to be at least a 1-month gap between that public notice and the auction date itself.
Give the borrower a real chance to react or find funds. Where are auctions advertised?
At least 2 newspapers, 1 regional language paper, 1 national daily, makes it pretty public.
Okay. Who actually runs the auction? Can just anyone do it?
No, it has to be either a trained employee of the lender or an impaneled auctioneer, someone officially approved, and there have to be safeguards. Plus, a reserve price must be set.
A minimum bid.
Exactly. At least 90% of the gold's current market value for the first auction attempt. If it fails twice, they can lower it, but still needs to be at least 85% for later attempts.
Okay, protects against super low bids. Where do these auctions happen physically?
The first try must be a physical auction, held in the same district as the branch where the loan originated.
Local first. What if it fails?
Then subsequent auctions can be held in an adjoining district, or they can be done online. But here's a crucial rule. The lender themselves, or anyone related to the lender, cannot bid or participate in the auction.
Ah, that prevents the lender just buying the gold cheap themselves. Very important. What happens after the sale?
Borrower gets full details, how much it sold for, how the loan balance was covered, if there's any money left over or surplus. That has to be refunded to the borrower within 7 working days of the lender getting the full auction payment. If there's a shortfall, the lender can try to recover that based on the loan agreement.
Clear rules on surplus refunds. That's good. The report also mentioned compensation rules.
Right. If the lender damages the collateral, they pay for repairs, loss or discrepancy, suitable compensation, and that delay in release point.
The INR 5,000 per day.
Yeah, if the delay beyond 7 working days is the lender's fault, it's 5,000 rupees per day compensation. If it's not their fault, they need to tell the borrower why. They also have to send reminders if people don't come pick up their gold after paying off the loan.
That 5K a day is a pretty strong incentive to be efficient. Any other rules jump out?
Generally, loan money should go straight to the borrower's bank account. Standard KYC rules apply, plus income tax rules on cash limits over 20,000 rupees.
So mostly bank transfers.
Yeah, and disbursements and repayments have to be direct between the lender and borrower's accounts. No third-party pass-through accounts allowed. And the report flags that having multiple loans running for one borrower is now getting stricter scrutiny. Concerns about misuse, perhaps.
It sounds incredibly thorough, a really comprehensive overhaul. And you said this replaces a whole bunch of older rules.
Yeah, the report mentions it repeals 31 older circulars, so it consolidates everything into one, albeit much more detailed, rule book.
Wow. Okay. That is a lot of new detail to absorb for these companies. So let's try and pull this all together. We've looked at the positive market cycle, how the big players are doing according to this ICICI report, and now this massive regulatory shift.
Right. So putting it all together from this deep dive into the report, what we see is a gold loan sector that's definitely getting a boost right now. Strong gold prices are the main engine, maybe helped by tighter conditions elsewhere in lending.
And that's driving growth, AUM, the actual gold tonnage coming in, customer numbers are up.
But as the report makes clear, it's not an even lift for everyone. We see clear differences in recent performance. Muthoot showing stronger metrics lately in things like tonnage and customer growth.
Compared to Manappuram, which faced declines in tonnage and has that MFI headwind. And this difference clearly shapes the analysts' ratings and outlook.
Exactly. The report also kind of cautions that while things look good now, the market valuations, especially for Manappuram, might already reflect a lot of that optimism.
And the elephant in the room remains.
Gold prices. A significant drop there is still the biggest risk factor that could quickly turn these tailwinds into headwinds.
And then you layer on these new RBI regulations. It's a massive overlay. While the report suggests the goal is better alignment and practice.
They undeniably impose some significant new requirements. Stricter credit checks for bigger loans, maintaining that LTV throughout the term, standardized valuation, handling, storage.
And those really detailed auction transparency rules.
Yeah, it's a comprehensive framework aiming to lift standards across the board, formalize operations, and ultimately give borrowers much clearer processes and protections from start to finish.
So summing up, a sector benefiting from good conditions, key players navigating it differently, influencing how analysts see them, and this huge regulatory change setting new, detailed ground rules.
It really highlights the dependence on gold prices, but also shows competition and diversification starting to matter more, and now this much tighter regulatory grip.
It really does. Okay, here's something to maybe mull over after this deep dive. With the gold loan sector becoming so much more regulated, so standardized, and with companies maybe looking to diversify more, how might all this change the sort of traditional image of a gold loan, and maybe who it serves or how it functions in India's broader financial system in the years ahead?